Exchange traded funds or ETFs have grown in popularity as an investment vehicle over the recent years as they combine the trading flexibility of a stock with the diversification and low cost benefits of a mutual fund. By definition, ETFs are passively managed mutual fund schemes that track a benchmark index and endeavor to reflect its performance. Now, even though investors have been pouring a lot of money into ETFs the world over, India still has a lot of ground to cover in terms of ETF market maturity. But the numbers look promising so far. As per a report from SEBI, assets under management for ETFs have almost doubled from 1.5 lakh crore rupees at the beginning of FY21 to almost 3 lakh crore rupees at the end of the fiscal year. So, if you are interested in knowing more about ETFs as an investment vehicle, you have arrived at your destination. I'm your host, Gautam Srinivasan, and to provide us with a complete guide on exchange traded funds and share some do's and don'ts along the way, I'm joined by Chintan Haria, Head of Product Development and Strategy at ICICI Prudential AMC. Chintan, great to have you with us for this conversation that serves to highlight the value of ETFs in today's investment landscape. Let's start with why ETFs are considered to be the most simple way to invest in a stock market. Your thoughts?
Thanks, Gautam. I think it's a very interesting topic, a new topic, and I probably take a minute to take investors a little back and then bring them up the curve as to why ETFs are becoming popular in India. If we look at the history in India in terms of investment solutions, we have seen in the past active funds doing very well and active funds being the fund of choice or investment of choice for most investors. As Indians have grown in terms of their
Go ahead. Go ahead.
sorry as Indians coming in terms of their financialization, as more Indians are getting aware, and the advent of digital technology to allow all investors to have with ease bank accounts, demat accounts, we've seen increase in people's interest towards equity markets in general. And as part of the increase in interest towards equity markets, all available solutions in equity markets are seeing flows improve. So you have effectively equity markets demat accounts grow from 3 crore demat accounts to 8 crore demat accounts. And as you know, for exchange traded funds or ETFs to trade on the exchange, you need demat accounts. And also, what's happening in the West happens in India, maybe with a lag. So we've seen in the Western world for the first time in 2020, in United States, the passive industry, that is the ETF industry, assets under management, which is the money which is invested in the ETFs, being higher than the money which is there in the active funds in US. Now that's a big change which has happened in the last 10 years because people have gravitated towards benchmark based investing, and ETFs have become the order of the day in terms of US. In India, of course, in the last 4 years, as more and more people have got educated, they have realized the power of ETFs as an investment vehicle to allow them to start their basic investing. And as you just rightly mentioned, ETF is nothing but a vehicle, a unit, which at the back end has a diversified portfolio. It could be defined as a market cap based portfolio or a sector based portfolio. But you buy one unit, in that one unit, you will have a set of portfolio diversification based on the index that you choose. So there are various ETFs, large cap ETFs, mid cap ETFs, sectoral ETFs. You choose what you want and you get the diversification. And it can be with as low as 50 rupees or 100 rupees per unit. And then you can build your portfolio over time. So the convenience which ETFs provide are leading to their growth.
All right. And considering the value which benchmark based investing brings to the table, how big is the ETF market slated to become, in your opinion? And why is it important to catch up with ETFs?
Sure. So I think investors in general would have all kinds of investments as part of their investment bouquet. Traditionally, we used to have fixed income instruments, bank deposits, etc. Then they graduated towards insurance-based investing, then mutual fund, equity-based investing on the active side. And now with a little bit more knowledge, they're basically moving towards the passive side or the ETF side as well. Now, in terms of value proposition, clearly because ETFs are tracking an index, and in general, to decide which fund on the active side will do better in a particular category requires a lot of effort, a lot of understanding, and I'm sure with gradual learning, many advisors have been able to pick and choose. But an investor who does not necessarily have the ability to go into depth of portfolios, they can start their journey straight away by investing in the benchmark itself and do it easily through the ETF route. That's what the exchange traded funds bring in, an easy way to participate in the market. You get all the stocks which are there in the index in the proportion of the index, and you can easily do it by buying on the exchange. And you can also sell it whenever you do need the money. Although, of course, much like any of your other equity investments, you need to have a long term horizon towards your equity ETF investing. While there are other classes also, there are debt ETFs, there are gold ETFs, now there are silver ETFs which have been recently launched. But as far as the equity ETFs, which are the more popular ETFs in India, you need to have a longer term time horizon, treat them as investments because trading is not everyone's cup of tea.
All right. So equity ETFs, debt ETFs, and commodity ETFs. Just to reiterate, those are the different categories of ETFs that you find. But to bring this conversation into focus for the average investors, looking at these different categories, how can an average investor look at these investment options in, say, different ETFs and kind of sync with their different life goals? Could you outline that out for our viewers?
Sure. So let's take the example of an Indian investor who's probably starting his journey. He's starting his journey of investments and does not know which equity to buy, how to invest in equity. They can simply pick up the large cap equity ETFs which are available. It could be based on the predominant indices which are there, and start building a portfolio, right? So the first part or first rule which every investor should understand is that saving is a very important virtue. In India, of course, it has been taught to us, courtesy our culture being into savings. And once you've saved, it is also important to invest. The best way to invest, of course, is to have an asset allocation plan. And it's something which, though not everyone is taught, everyone should definitely focus. They should have an asset allocation plan. How much of your money should go in equity? How much of your money should go in debt? And once you've decided that asset allocation plan, and for that, you need to have an advisor who can guide you properly, you basically then choose the underlying investment. For most investors, the first choice can be a simple ETF based on a benchmark index, on a large cap benchmark index. And then as you learn more about investments, because equity investments, unlike your fixed income investments, have their ups and downs. And we just saw yesterday, right, because of an event which happened outside of India, which probably had less to do with India. We saw Indian equity markets react by more than 4% of around 4.5% on the downside. So equities, by virtue of they being, let's say, impacted by a lot of factors, are up and down, are more volatile. But as an investor, if you are investing and allocating for the long term, just simply choose a large cap based ETF to start with your investment portfolio. Build that over a period of time. Whenever markets correct, buy more, and then suddenly you'll realize that over a period of time you have accumulated enough units on the ETF, and as the markets grow, your ETF value will also grow in the large cap universe, and you would have created wealth through the equity platform with the easy way of investing in exchange traded funds.
All right, let's expand some of the points in detail, considering the nature and profile of investors are different. And, we want to understand how, say, a basket of ETFs helps meet different life goals at different stages of life for, say, people of different age groups. So looking at the differences, how do ETFs fit in?
Sure. So I'm sure there are different kinds of investors who have different requirements, who have different risk taking ability, and different goals as well. And as part of their goal setting and risk ability, they have a lot of options today. Unlike maybe 5 years back, and you asked the question that why are ETFs becoming so popular today? The reason is that maybe 5 years, 7 years back, there were not enough ETFs available in terms of the diversity of ETFs that are there in India. Today, if you see, there are market capitalization based ETFs, there are sectoral ETFs, there are smart beta ETFs for you to choose from. Now, while all of this may sound like Greek and Latin for a lay investor, it very simply is that what is the underlying selection, or what is the basket of stocks in which your money is ultimately invested? Is it large cap? Is it mid cap? Is it small cap? Is it auto sector, or a banking sector, or a technology sector? So what does an ETF do? Let's take an example and it will make it clear. Suppose you are bullish on the technology sector, or right now we are bullish on banking. So let me give a more apt example on banking. Banking for the last 2-3 years has underperformed the benchmark indices. They're coming out of a trough. And we say that, okay, next 2-3 years, if India's growth is good, banking sector will do well. Now, you as an investor want to participate in banking. You can very easily do it by investing your money in the bank index or the bank ETF, so to say. And that bank ETF will provide you, let's say, 12 underlying constituents are there in the bank ETF. And in those 12 underlying constituents in the weight of the index, the money will go. So the bank ETF, which is there, will allow you to participate in banks. That's how you can choose a sector which you like, and you can start very easily investing. You get diversification of 12 banks in one particular unit or a one particular ETF, which also reduces your risk. Because if you go and buy a single bank and that bank doesn't do well while other banks do well, you'll end up probably missing out. So if you're bullish on a sector, choose a sectoral index. As far as market is concerned, and you want a market based investment, you have 500 stock market based indices, you have 50 stock market based indices, which you can simply put your money in. And as India grows, and they have all the sectors in one particular basket itself. If you look at the benchmark indices or the market indices, which are very popular, you'll have 50 stocks, some in banking, some in technology, some in auto, some in FMCG. You'll find all India's leading stocks, India's best known stocks or household names as part of that 50 stock basket. And if you are investing in that, with India's growth, you will also see growth in those stocks. So if India has to grow and those underlying companies grow, you can grow with those companies by investing in the ETF of those companies. So that's also one way in which you can participate in the market in a very easy way.
Absolutely. And you've busted one of the myths there, which is that ETFs only offer broader market exposure. But some of the other myths out there which are associated with ETFs, whether it's about, it's only for market timers or so on and so forth.
Absolutely not. I think it's one of the most convenient ways. It's a cheaper way as well because there's no fund management involved. There's no active fund management involved. Whatever is the benchmark index in that weight, in that proportion, the same names you get. So there's also transparency. You come to know exactly where your money is going to go in what proportion. And by virtue of it being a passive fund where fund management is not there or active fund management is not there, the costs are also lower. Plus the fact that imagine if you had to buy one share of a particular stock which is costing, let's say, 1,000 rupees, and you may have limited capital, you'll not be able to buy all the shares. But in the unit form, the ETF allows you to participate. Let's say the 50 stock index, which is traded on the exchange, it will be traded probably at 80 rupees or 110 rupees or maybe therein and thereabout. So the idea is that with lesser amount, you are able to accumulate more units. So ETFs are meant for everyone. It's not only meant for those who have a very large corpus or those who are really rich and understand the markets. In fact, it's the other way around. Those who do not understand the markets and want to start their journey of market investment, they can also participate in ETFs and over a period of time, slowly but surely accumulate one units. Let's take the example of gold, right? Gold ETFs are popular as well in India. In the last 2 years, they've become much more popular because stepping out of the house has been difficult because of the crisis which we have been in terms of the pandemic. And if you wanted to allocate some money to gold, right? Suppose you have 500 rupees to allocate to gold. Now, with 500 rupees to allocate to gold, I find it difficult for you to go to a jeweler and try and get gold in the physical form because in 500 rupees, it's unlikely you'll make or you'll get anything. But gold units which are traded on the exchange are anywhere between 40 to 60 rupees, maybe, therein and thereabout. One unit. One unit is equal to 1 gram. So with as low as 1 gram, you are able to basically get an exposure to gold. So if you have 500 rupees savings, you want to put in gold, you'll be able to buy, let's say, 1,000th of a gram, I should say. So you'll be able to buy 1,000th of a gram, which is one unit. With 500 rupees also you can buy. With 200 rupees also you can buy. So you'll keep accumulating units and gather units very efficiently without having to worry about the storage of the gold, the purity of the gold, because all of that is taken care of by the asset management company. And you will be getting access to gold in a very easy way without having to worry about anything as far as gold. And as gold prices go up, which they have in the last few weeks, courtesy whatever is happening in the geopolitical situation, you get the advantage of gold prices going up via the ETFs. So these are many of the use cases which people will find. So it's not just equity, it can be gold, it can be silver. Silver, courtesy the approvals from the regulatory authorities, was launched in January in India, and I think people have caught on to the silver ETF, as a easy vehicle because silver is a very bulky commodity. So it's don't think of ETFs as only equity, but there is equity, there is silver, there is gold, and you can create a portfolio. You can create a balanced portfolio of with all the ETFs which are available. And if you start investing, and you'll know how easy it is, I'm sure more and more money will get allocated of yours in ETFs. The important thing is have patience, think long term, especially when it comes to equity. Do not end up trading, because if you buy and sell, it may not work well for you. It requires a lot of specialized training for anyone to do that.
So in a sense, it democratizes access to different growth stories for investors. But you spoke about risk earlier. Why are ETFs said to be low risk instruments, in your opinion?
Right. So ETFs, when compared to a single stock, definitely provide you with a lesser risk, because of the fact that when an ETF has an underlying set of, let's say, 50 stocks diversified into various sectors, your risk gets divided into those 50 stocks with different sectors and different stocks within the sector. So you have 50 different stocks which may have different risk profiles. While if you invest in a single stock, your risk profile probably may increase, because the single stock can go through any of the issues which a single company can go through. The product can become obsolete, the growth can be a challenge, the company can go through a management downturn, etc. Hence, ETFs in general, relative to individual investing, for a lay investor or a retail investor, becomes a good diversified way of participating in the markets, where you're reducing your risk while participating in the upside through a diversified set of stocks.
All right, let's also speak on liquidity and why it's important from a broader market perspective. And why are ETFs best known for liquidity for the average investor? Your thoughts on that, Chintan?
Yeah, so the ETF ecosystem, especially in US, is very evolved. In US, you find ETFs are very liquid. Apart from US, everywhere else, it's a catch-up game, so to say. So even in India, if you see, relative to where we were 4 5 years back, the exchange liquidity of ETFs has improved significantly. And as more and more investors come in, ultimately liquidity is a function of more participation. If earlier there were, say, 10,000 investors investing in ETFs, today if it is 5 lakh investors investing in ETF, tomorrow it becomes 25 lakh investors, and so on and so forth. You see improvement in the natural liquidity on the exchange, because more people are buying and selling. And that's the whole advantage of the whole change that has happened in India, in terms of more number of people having demat accounts and participating. So liquidity begets liquidity. As more people buy and sell, that's a virtuous cycle. We've seen it happen on the equity side. We've seen it happen on the derivative side. If you see, India is one of the largest derivative exchanges. We have largest, or our exchange traded volume on equities has gone up from 16,000 crores to average of 60,000 crores a day in the last 5 years or so. So as more people participate, the screen liquidity also improves, and as an investor, that's a good thing for you. And apart from the fact that ETFs are new in India and there is a relatively less understanding, we as asset management companies and all asset management companies providing ETFs also would ensure that as an investor who's coming on the exchange to buy and sell, the prices are as fair as possible for the investor. And that's where the concept of market makers comes into play, where there are market makers or authorized participants who would ensure the screen has enough buy and sell for a retail investor to come and buy and sell against that authorized participant, should there not be a natural liquidity on the exchange.
All right, bringing all these points together, how are ETFs ideal for first time investors?
Correct. So, first-time investors, in fact, in India, the knowledge of equities is something which has improved significantly. I think, courtesy all the good work which is happening across the board, where investor education drives are ensuring people know a little bit more about equities than earlier. So, till 1990s, we had this equity culture. Then it kind of weaned down, and last 3 4 years, it has come up in a big way. It is also reflected in the overall growth of mutual funds. And so, from a first-time investor perspective, the ease with which they can open a bank account, a demat account. Similarly, the ease with which they can also go and buy an ETF on the exchange allows them to participate in a diversified basket. So I would urge all investors listening in that give yourself that first push in terms of going on the exchange and buying a diversified set, especially in volatile times, because single stocks can be a bit more risky. You need a lot of research that you need to do in terms of the single stock. What is the sector doing? How is the company doing? How is the company management? Are they the cost leaders? Are they the leaders in terms of their geographical footprint. All of that is single country, a single company risk, which probably you as a investor may not be able to get into detail. That's the work of research analysts, and that's where the active fund management team with their professional expertise is doing it day in and day out. To avoid obvious mistakes which you may make in picking up individual stocks, ETFs are a good route for you, because ETFs give you a combination of securities in one go. Few companies which are put together, and all of it is transparent. The good part is you can straight away go on the website. You know the methodology. You know, okay, what is the universe of this particular ETF? Where is the money going to go? And what are the underlying stocks? And as a basket of underlying stocks together, you can participate in an easy way. You may be bullish on auto, for example. You may be bullish on pharmaceuticals or healthcare, or you may be bullish on India as a market. And if you're bullish on India as a market, just go for the 50 or 30 stock diversified universe as well. So I think for the first time investor, start with ETF investing. Don't think ETFs are only equity. You can start with gold ETFs and accumulate units in silver as well. And over a period of time, your portfolio will keep on growing. And with patience, it will also keep compounding.
All right. Recapping a point mentioned earlier, in terms of investing correctly, how can one carry out the allocation while accommodating ETFs in their investment portfolios? Your thoughts, Chintan?
Sure. So generally, of course, the allocation is a very individual choice, because each individual is different. In fact, two brothers also who may have been born on the same day, they can have a completely different risk profile. Courtesy, human beings very emotional. So the emotional greed and fear is what probably separates the risk profiles of individuals, and hence to each one his own. You can potentially have a higher risk profile, someone else will not. But in general, rule of thumb, generally people are anywhere today, if you see a good portfolio allocation, are anywhere in the range of 50 to 60% in dynamic asset allocation plans. That's a category which has grown, and we believe that that should be the core category as far as any investor is concerned. The dynamic asset allocation category, 50 to 60%. The balance 20% can be a mix of the flexi category, flexi cap category, mid cap, small cap category, depending on the investor. And the rest 20% is where the passives come in, or the ETFs come in. We've seen people have a mix of active and passive, and that's where in that 20-25% passive bucket that you have, you can start with a mix of maybe 10 to 15% in equities and 5 to 10% in gold and silver. And I think as an overall portfolio bucket, it will be a very nice, healthy, balanced portfolio, diversified between active, passive, and within passive between equity and debt, and equity and gold and silver, as part of your overall allocation.
All right. Now, in any conversation around investments, how can tax be far behind? So, want to understand from you, what are the tax implications on ETFs? If you could outline the tax implications on ETFs for our viewers.
Sure. So equities in India are taxed, as you all know. If you have more than 12 months holding in equities, it is at 10% plus cess. If you have less than 12 months holding, you have 15% plus cess. Similar to the equity taxation, that is the shares taxation, the equity ETFs are also taxed in a similar way. So you have equity capital gains tax on ETFs which are which have a minimum 65% underlying equity. On the gold and silver, because they are commodities, the taxation is slightly different. It is other than equity. And that basically for gold and silver ETFs, the taxation is you have to hold for a minimum of 3 years for getting the capital gains benefit. If you hold for less than 3 years and you haven't have any gains in gold and silver, you will have to pay your marginal rate of tax. But if you held it for 3 years and above, and then you book your gains, on the gains, you not only get the indexation benefit. What is indexation benefit? Most of you are aware that as the years go by, the inflation, that is the RBI's cost inflation index, keeps on rising, and your cost, which was 100 rupees say 5 years back, with the RBI reference rate, will probably become, let's say, 120. And if you've sold it for 150, if you sold your gold and silver for 150, for example, you will not be taxed as 150 minus 100. You will be taxed at 150 minus the increased cost. So you will be taxed 20% on the index cost of acquisition. And so your taxation comes down if you hold for more than 3 years. So that's the other than equities taxation. Equities taxation is very simple. So there are only two types of taxation in mutual funds, just to revise. which is applicable to ETFs as well. If you invest in an equity ETF, you get the benefit similar to equity share of capital gains taxation, which is less than 1 year holding 15% plus cess, more than 1 year you get 10% plus cess. And if you are investing in gold or silver or any debt ETF, which is other than equity, you have to wait for 3 years to get the indexation benefit. It is called long term. And on that indexed cost of in acquisition, you have to pay 20% tax, which is also something which is, let's say, a good thing from an investor, because your cost is increasing. In other words, you have to pay lesser tax, and that too at a rate which is lesser than what would be your normal marginal rate of tax at maybe 25 or 30%.
All right, Chintan, as we wrap up the conversation, what's the key message that you think viewers watching this presentation should take away when it comes to the value of ETFs?
Sure. So, like we've probably spoken a couple of times in this conversation, think of ETFs as your first step towards investing, and that probably will then continue towards the growth that you will see in terms of your overall portfolio. ETFs are available in various kinds, and of course, because of paucity of time, we are not able to be discussing every type, right? But there are market cap based ETFs, that is the large cap, mid cap, small cap. There is sectoral ETF, that is auto, banking, technology, healthcare, so on and so forth, infrastructure for that matter. Then you have the ETFs which are based on smart beta, that is factors, right? You have low volatility, value, a combination of factors like alpha, low vol. So you have those factor based ETFs also. And I understand that maybe right now you may not know what smart beta ETFs are, but at a later date, if we can do another session, I'll be happy to take in detail what are factors and how that is important and what it brings to you as an investor. And then there is debt ETFs. You have gold and silver ETFs as well. So there is a wide range of ETFs. Don't think of ETF as only, okay, this only equity and it's only large cap. No, there's a wide range of ETFs which are possible for you to invest in. The building blocks for your wealth creation are same as any investment. You need to be having an asset allocation plan and then choose the right product for you to participate in. We believe that ETFs provide a good role for you in a low cost way to participate in the market growth, because you get a diversification benefit, and ETFs are very transparent for you to look at. And I think over time you will realize that as you invest more and you keep building units, be it in equity, gold or silver, it becomes a habit, and that habit is a good habit because it will force you to save, force you to invest, and then create wealth for a rainy day in the future. Thank you.
Well, as the tagline reads, ETFs hai, easy hai. Thank you so much for giving us a very clear outline, Chintan. On that note, it's time to conclude our conversation around ETFs and what they bring to the table for investors. Again, I'd like to thank Chintan for providing a complete guide on ETFs. And of course, thank you to our viewers for watching. Till next time, this is Gautam Srinivasan signing off. Have a great day.
Have a great weekend.
Thank you.